Hello, everyone. Welcome to Kathy's Caffeinated Market Buzz. I'm so glad to be back. Please let me know if you can hear me, see me. Let me share my screen. If you can, please let me know either in the Ask Kathy room or in the YouTube live stream. Let me know that everything is running okay, and we will get underway. And for those of you that are on the YouTube live stream, let me know where you're coming in from. I'm delighted to have you here. It's been a while since I've been on, and we have a lot to talk about this week. So everything looks good. The screen looks good. It looks good on my end. Thank you, Miguel. Thank you, Andrew. So let's go ahead and kick off and get started. So I had a fantastic trip in Japan. I have so much to report on the ground. I've done some shorts. I'm going to put together a longer video on my thoughts on what's changing in the Japanese economy and how that's being reflected in a lot of the economic data. Now, on top of that, we had a big week over the past 2 weeks in the markets last week, we had some really good trades, particularly in dollar yen. And between the CrowdStrike outage and Biden pulling out, and I guess Trump getting shot at and Biden pulling out of the race, this new trading leak is almost, guaranteed to bring more headlines, more excitement, and hopefully more volatility with it. And that's really what we're going to go over today. What's interesting, though, is that while politics is front and center on all of the front page news as well as the business news websites, the key here is that the market impact right now is still relatively limited, because if we look at how the markets are moving right now, you will see, if you look at the upper right hand corner of my charts, stock futures are up a little bit. Dow futures are up 84 points. The US dollar is mostly lower. It's kind of mixed. It's lower against the Japanese yen for sure. It is higher against the Swiss franc, Australian, New Zealand dollars. Earlier, it was also lower against euro and sterling, but it seems to be rebounding a bit, which is certainly a little bit at odds with the drop in US yields. But one way or the other, we're not seeing a dramatic market reaction. So why have we not seen a dramatic market reaction to Biden pulling out of the race? I mean, this is obviously a historic announcement. It's very rare to have a president not seek re-election, and especially to pull out of the race so close to the election itself. And I think a lot of that has to do with right now the uncertainty about who's going to be on the top ticket for the Democrats. Hopefully that'll get resolved this week. It seems like they're rallying behind the VP. We don't know. Right now, the polls still show that Trump is in the lead, and even against Harris, he's likely to win. But as traders, what we need to think about is, what is the market implication? And I plan to do a video on this, but we haven't really got an opportunity to talk about this, which is that if we do have a Trump victory, there's a few market implications. First off, Trump is seen to have policies that are more beneficial to domestic firms. He's really favoring protectionism, and he really very much favors and obviously this would not happen, but a blanket import tax. But it certainly shows you his thinking. So certain companies that I guess sell basically provide most of the services domestically will probably benefit. And any companies trying to sell to the US will probably be at a disadvantage. At the same time, the idea is that Trump, unlike a lot of the other presidents, is much more vocal about not needing, I guess, a strong US dollar, and that a weak dollar could be is what the US economy needs. Now, of course, this is complicated because a weaker dollar would set back the Fed's efforts, because it would drive up inflationary pressures, and a stronger dollar is certainly helping the Fed by driving down inflationary pressures. So both him as well as the VP candidate seem to be much more vocal about a weaker dollar. Now, with Biden dropping out of the race and the Dems having a little bit more of a chance at victory, that means maybe the stronger dollar policy could continue. Maybe the Fed could continue on their path and Powell will not be replaced. Maybe the policies that we've seen right now will persist as well. So the idea here is that the greater chances of the Dems right now should actually be dollar positive and stock market negative. But we have not seen that movement yet in the markets, perhaps because the markets still think that Trump is slated to win. So that's what I'm thinking is the whole idea behind the market impact. And on top of that, everyone's just waiting to see. So perhaps the markets are taking a grain of salt. I'm sure Boris will share his thoughts on this as well. But this is the reason why I don't think we're seeing huge moves on the market, in the market at the start of trade this week, even though this is a huge monumental announcement. Now, we also have a lot of data this week, but I do want to mention another reason why stocks are rallying is because the pullback that we had last week in stocks is the biggest pullback since we had in April. And I'm also surprised by so this is today's rally in stocks could be simply a rebound after that. I'm also surprised the stock's doing well after this huge CrowdStrike issue. I know that my flight back to New York was affected, and there's still Delta is still canceling a lot of flights. A lot of businesses were affected outside of their airline sector. So I'm actually surprised that we're seeing rallies in the Dow and tech stocks in general. But it could just be a rebound because August, we've talked about how July, and went to the beginning of July, I talked about how July is a good month for stocks. But August and September tend to be a very weak month for stocks. So August and September tend to be a very weak month for stocks. And as we get closer to that, perhaps, the growing possibility of a Dem victory or a greater chance of victory could pull stocks lower and reinforce the seasonality that we tend to see in stocks in August and September. So, that is something to keep in the back of your minds as we look ahead to this week's data. Now, over the past 2 weeks that I've been gone, in general, we have seen softer economic data from the US. Inflation data softer, retail sales data was softer. This week, the most important report is going to be the Q2 GDP report, the first advanced release of Q2 GDP. And given the weakness of retail sales, chances are US growth is going to slow as well. So there's no question that the US economy is slowing. And I think that is the reason, quote unquote, for the weakness in the dollar. That is the reason why I think we're seeing the US dollar weaken, because overall, the whole idea here is that the US economy is slowing. The Fed is getting closer and more likely to cut interest rates in September. Let's take a look at CME Fed Fund futures just to check how things look. Taking a look at CME Fed Fund futures, we can see that with the CME Fed Fund futures, market is basically pricing in a 95% chance of a interest rate cut in September. And then, if we look in December, there is basically a 95% chance of 2 interest rate cuts fully priced in. So the market has certainly moved more towards easing, and that is driving the US dollar lower. We also have the PCE deflator, personal income, personal spending at the end of the week. But with CPI growth already slowing, I think the market is not going to pay too much heed to the PCE deflator. I think overall, the market's going to look at it as more a situation where inflation is slowing. Even if the PCE surprises down to the upside, I don't think they're going to really care about that all that much. So as a result, I'm dollar bearish, which is why we had dollar bearish here, because I think GDP is going to be softer. I think that overall, the weakness that we have seen in US data will continue to affect the dollar, particularly against the Japanese yen. This is also a week where we have a lot of PMI reports from all corners of the globe, and that includes the Eurozone, the UK, Australia, Japan. And overall, Eurozone data is weakening. The ZEW survey was weaker. The IFO report will probably be weaker. So in general, we're seeing data weaken, and the euro will probably soften as a result. So what you're seeing here is that, what you're seeing here is that I'm bearish euros, and I think euro could pull lower this week as well, more against the crosses than anything else. Sterling, I'm neutral because sterling I'm bearish because last week we had mostly weaker UK data. We have UK PMIs this week, which could also move lower with the PMIs, in general, we've seen softness in there, but we did see stronger CPI index, so it's a tough call. Overall, the market is divided on whether the BOE is going to lower interest rates next month. The ECB, when they met at the last meeting while I was away, they basically left the door open for September easing, and the market is still thinking that a September easing could happen. BOE is a little bit more wishy-washy, so sterling I think is still bearish, but should outperform euro. And then the Australian dollar, I'm neutral. We have really good Australian jobs report last week, but the PMIs are expected to be softer this week. So I'm neutral. Aussie is leading the slide today. We had all this hope for the Chinese plenum, that they were going to come out with some major stimulus package, but unfortunately they did not. And that is another reason why Aussie could tip lower, because they did not come up with more stimulus, and this week's PMIs are expected to be softer, and I think stocks can begin to pull back. I'm also bearish the Canadian dollar. I think the Bank of Canada, there's a good chance that they could lower interest rates this week. The market is divided. The market is pricing in a 90% chance of a rate cut, but economists don't think it's necessarily happening. So because the market is divided, I think there's scope for loonie weakness. And I think the loonie itself hasn't fully priced in the possibility of an interest rate cut by the Bank of Canada. So that's why I'm bearish. Also bearish Kiwis, even though we have stronger trade data. Overall, the Chinese plenum not delivering anything. Also, Kiwi PMIs have been quite weak. So overall, I think we're going to see ongoing Kiwi weakness. Swiss franc, I'm neutral, but neutral bullish because I think the dollar is going to pull back. I think the euro is going to pull back. Yen, I'm bullish. We have yen PMIs, yen CPIs. The Japanese economy is doing very well as a result of tourism, as well as a weak yen. And so I think all that will be reflected in this week's economic reports. Now, taking a look at the economic calendar and going through this day by day, as I said, we already had the New Zealand trade data, which came in stronger, but exports and imports were both weaker, which is not great news. Chinese interest rates are lower, affecting Aussie and Kiwi. Today, we don't have anything in terms of US or Eurozone data. Tomorrow, things start to come in. We have US existing home sales. That should be stronger, I think, actually, because of lower interest rates. And then we have in the evening Australian PMIs, which should be weaker, Japanese PMIs, which should be stronger, helping the Japanese yen. And then on Wednesday, we get the Eurozone and UK PMIs. So really big day for Euro and pounds. And the market is actually looking for stronger numbers all around. So there is scope for downside if we do get a miss on any front. But the market is looking for some stabilization in Europe and the UK. And these are very important releases. My favorite indicators are always the Eurozone PMIs. So, definitely pay attention to that. And then we have the Bank of Canada rate decision that's coming out. As I said, the market is looking for is pricing in a 25 basis point rate cut. So if we get that, that should be bearish for loonie, because I don't think they're going to say that they're done with lowering interest rates. We also have new home sales, which will be interesting. And then on Thursday with the German IFO report, which is expected to be stronger. Bit of a surprise considering that the ZEW was weaker. We also have durable goods orders and the Q2 GDP number for the US, which is expected to be stronger. I think there's scope for a downside surprise there that could drive the dollar lower, stocks lower, because retail sales did weaken in the second quarter. And then we have Japanese inflation data, which is expected to be stronger. And I can tell you from my trip in Japan, I talked to a lot of business owners, and they said that for a very long time, the Japanese had struggled to raise prices. And there was a very famous story about how a candy company was trying to raise prices from 10 yen to 12 yen, which is basically less than 10 cents. We're talking about here. And they held a huge press conference. They bowed an apology, and it's just a reflection of how fearful the Japanese have been about raising prices. But the weakness of the yen has given them a perfect excuse now, as their cost of doing business has raised prices. And it's allowed these businesses to raise prices, to raise wages, and it's becoming much more of a norm in the Japanese economy. And I think we're going to see that much more in Japanese CPI as well. And then on Friday, we have personal income, personal spending, the core PCE deflator, which is expected to be softer, along with the University of Michigan Consumer Sentiment Index. Now, taking a look at the charts, you can see that with Euro, Euro is moving lower. It's tipping lower. And, I'm bearish Euros. I'm bearish dollars, but I think that, you know, euro definitely looks a little bit more bearish right now. And I think that it could drop down to 108.40. Pound dollar also looking kind of bearish here, could move lower as well. Dollar yen looks like there's support right at the 100 SMA. It's a very important support. I think that it could move lower but could hold it. All of this tells me that the yen crosses are probably the most bearish here. And you know, that is something that is, you know, that I think could see more losses, like euro yen, Kiwi yen. We were all over the short yen cross trades last week, and I think that those could have continuation moves. Dollar Swiss has rallied, but I think it's meetings. There's a lot of resistance up at 89.40, 89. I do think we could see more resistance in dollar Swiss. Aussie also moving lower, but there's support, but Aussie's getting overstretched. So I think it should bounce off of 66.30. I think it's due for a bounce. And Kiwi, though, is selling off quite a bit, but I also think it's getting overstretched. And if we draw some fibs here, you may see some fibs, you know, well, this is at 59.30. We could see a little bit more extension, but I think it is getting a little bit overstretched, so we'll have to see. But overall, you know, this is a week where we don't have a lot of huge, we have some important data, but not any game changers. And so there'll be a lot of opportunities to trade. If you have any questions, please let me know. In terms of gold, I'll let Boris talk about it, but generally speaking, gold has pulled back quite a bit after hitting new highs. I think it's going to find some support at these levels, but I'll let Boris share his thoughts on gold. Any questions for me before I turn it over to Boris?
Hi guys, hi everybody. Good morning, good afternoon, good evening. I sound like a frog because I have a little bit of a cold, but hope everybody is doing really well. Very excited to have you guys with us this week. Don't forget, I'm going to be trading live Tuesday and Thursday. I'm going to just post the let me post the link in here. God, I cannot type it. I can't believe it. A four-letter word. I still can't type it. So be sure to make sure to join me tomorrow and Wednesday. I have literally the coolest thing I did over the weekend, which is our scalping methodology. This methodology that has already funded more than $10 million worth of funded accounts for most of my traders. I have systematized it into a really beautiful quantitative system. So I'm actually going to share it with you just for 1 second, just to show you the preview. But we're going to talk a lot about it tomorrow. So be sure to come join me on. Let me take control of the screen for a second. Show my screen. I want to show 3 clean. Okay. Let me see if you guys are seeing my screen here for a second. Let's make sure. Yep, you should be able to see my screen. Okay, so this is S&P, Dow, Gold, NASDAQ. Works on all of them, works on them really well. And it's a little bit complicated to explain today because, you know, we have a limited amount of time, but I'm going to talk about it tomorrow. But it's a really cool idea of understanding momentum and trend to pluck and choose the absolute best places to scalp. Just to give you an idea, without me trying at all today, I'm up 217 bucks just on 3 or 4 trades today, trading the system from last night. Hopefully I'm gonna get it up to about 500 by the end of the day. I'm gonna show you all of it tomorrow. It's absolutely free to anybody who is part of our BK family. So I'm going to give you the link here. I'm going to give you 2 links here if you want to join our BK family. So join us over here. That's a discount link for just 1 month. Or if you want to join my coaching services, that will give you 3 months at a really steep discount. So make sure you sign up and get this stuff because I am so excited about this thing. This thing is money every which way you want to look at it. And it's incredibly valuable in kind of understanding exactly what the price action is telling us today. So on a broader scale, obviously, I think we'll start with gold. There was a lot of people talking about, you know, what's going on with gold. Gold clearly, after hitting 2450, having a big sell-off moment. Why is gold having a sell-off moment today? I think, frankly, profit taking, because long term, I'm actually incredibly bullish on gold. I guess I suppose you know, it's profit taking if the market is adjusting to the possibility that Trump may not win. A Trump win, in my opinion, is pretty bullish gold for a whole bunch of reasons. I mean, it's 3.5 months away, so lots of different things can happen. But to understand why, I spoke about this on CNBC last week. Why is a Trump victory such a powerful boost for gold? Two reasons. Trump really wants to run kind of a mercantilist economy, which means that he wants a lower dollar. A weaker dollar, by its very essence means lower gold. It's just implied. If you're going to lower the dollar, gold is going to go up. But he's also very aggressive on rates. The guy is a real estate developer. He hates high interest rates. He wants low interest rates. He understands that's very stimulative to the economy. He's going to press Powell every which way to Sunday to keep rates low. That's also very positive for gold. So the correction in gold today may be just simply the market adjusting the odds that the Trump victory may not be assured, even though I know all the polls are showing it's a 60-30 bet right now, Trump against Kamala. Yeah, but we all know it's early. The narrative has really changed. We don't even know if Kamala is going to be the Democratic nominee. But the point is, the narrative has changed. It was a very, very clean, clear setup, Biden versus Trump. Almost nobody thought that Biden would win under those conditions. But now we have a completely different arrangement. So the market may be just simply adjusting on a short-term basis. But overall, it really looks to me like gold is a long-term buy with some corrective moves along the way. Obviously, we can take advantage of it on a corrective measure here, selling all of these declines here, and then we can take a look at it on a reversal pattern here, buying all the dips. As far as the equities go, they are rich. I was just looking at the numbers. Equities are really rich. We're at 25 forward PE against 23, which was normal, and 21, which is average. This is for the S&P. So we are rich, rich, rich. This is a market price for some very unlikely growth, in my opinion. It's market price basically for Trump victory, which is running way, way ahead of the actual fundamental data. So do I think, as Kathy and I have been talking about, the fact that July, August is going to be a turbulent time for equities? Quite likely, quite likely. We could see some sell-offs here as things go on. Furthermore, we really have no idea geopolitically what's going on. Think about the absolute turmoil that's going on the geopolitical front that could have some very serious implications for us. So number one, Israelis just blew up the second largest port in Yemen. And the question is Iran going to escalate or de-escalate given the situation right now? Biden administration seems to be completely out to lunch and not engaged in the Middle East at all. That creates, a power vacuum. The Chinese have a huge power vacuum too. I mean, Bill Ackman, who is a very, very big hedge fund manager, just posted today that, given the way the announcement was made, but nobody has seen Biden, nobody has seen Biden speak. Biden released a letter on his personal stationery on X. Nobody even knows if Biden is around or alive at this point, frankly. legitimate questions for the United States, the President of the United States. This opens up all sorts of geopolitical stress in the Taiwan Straits. I don't think any of this is going to happen. It's all fear mongering. It's all stuff, but it doesn't mean they can't. This has been, if nothing else, this has been an absolutely crazy news cycle for the last 2 weeks, right? Nobody, every single week there seems to be a more crazier news cycle. There was somebody on Twitter who was just joking around that the only thing that we need now is space aliens to really complete the kind of crazy news cycles we're having. So do I think we're vulnerable here? Probably, but until we fall, there's no reason to short, right? Until the markets start to show some serious decline, there's no reason to short. We're long we're long and squeezing harder, and until this kind of stops. 20,000 seems to have been a big resistance in the NASDAQ. That I think could be another cement ceiling. So we rise up 20,000, probably come back down. That's how I would play it from a sort of a tactical point of view. But on a near-term basis, we'll just follow the price action and try to scalp it up and make it as profitable as we can. Everybody, please be sure to join me tomorrow. Join me Wednesday, because not only are we going to have a great time scalping, I'm going to show you a purely quantitative way, zero doubt. If this, then that, do this. If this, then that. There is no interpretive need there. Everything is quantified, so it's incredibly easy to make super fast scalp decisions for you. And I'm going to show you exactly how those scalp decisions are made. It's going to blow your mind. It's going to blow your mind in its simplicity. I mean, many of you know that I've been completely obsessed with the science of complexity and the science of chaos, which is sort of like the modern new sciences, all of which are based upon the idea of very simple elements creating very, very complex structures, which is exactly what the market is like. And I've been able to, I think, decompose the very complex structures of trend into very, very simple elements of trend that we can quantify and we can trade really effectively. So come join me tomorrow. I'm super excited to share that with you. Everybody in BK, I'm going to post the new indicator as soon as we get off the air. And if you want to join me, as I said, here's the link to join us in BK right now. And if you do it, you'll get it right away. Let me put this up here. And if you want to join my coaching, here's the link for coaching. Okay. And as always, I'll see you guys tomorrow for live trading for everybody else and for everybody in BK. We start in 15 minutes. I'll see everybody later. Take care.